Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. Hope you had a great weekend. Stock market's back open today. What's it doing? Well, it's having a down day. The Dow Jones down about 500 points. The NASDAQ down about 250 points. Now we had the rally up. We had the short covering rally, the bear market rally, if you will, and it got to the end of the rally, and that was ended on very light volume. When we were continuing higher on light volume, we knew we were close to the end, and sure enough, we got the pullback. We got a rejection off the 200-day moving average on the SPY, and now we've dropped down to the 20-day moving average. Now, for you bulls that expect the market to go higher, the 20-day moving average will act as support. And we may bounce off of that and get a little rebound from here. You see, we've had two gap downs from the top. On Friday, we were up here, and then we gapped down on the open. Now, today, the market dropped a little more, and then today we gapped down again. So we have two gaps above us. We have several gaps below us. Now, we may bounce off this 20-day moving average and come and fill those two gaps before the market heads for lower. The market's going to come in. It just is. The short covering rally has run its course. It's come to an end. The bear market rally, if you will, is now over, officially over. Now, I do think they're going to try to get a little bounce here before we extend the decline. The decline will get extended, but there could be a bounce coming. Now, you'll notice how the VIX has just spiked higher, up about, 13% today, right? So that tells us that in the next day or two, we're going to get, the bounce, the recovery bounce. But we're still going to head lower eventually. The market's getting ready to come back in. Once again, just my opinion. You may have the opinion that the market's going to resume this rally and continue higher. I don't believe that. I believe we've seen the top at the 200-day, and we're going to come down. The market's going to come in. We're probably going to get a bounce here off this 20-day. Nothing goes straight up. Nothing goes straight down. But we probably are going to get a bounce here. All right, so let's move over to the real estate market. I want to talk about kind of what's going on to prop the market up. A lot of people think the market's going to continue higher. I do not believe that. Well, I think we've already seen the top, and I think we started the decline, and I think the decline is starting to accelerate, and I think it's got a lot more room on the downside to go. Now, there's people that think, that the market's going to continue higher. I'm sure in your area, it probably will continue higher, but here's what they're doing to prop the market up. Here's the reason that we're in the biggest bubble of all time, right? Okay, so what's happened in the last 2 years? Well, in the last 2 years, we printed $6 trillion, trillion with the T, to prop up the asset bubbles, and it's been working, right? We've got this bubble bigger than it was in 2008 when the subprime crashed. This bubble has inflated bigger. And we did it by printing $6 trillion. How else did we do it? Well, we've held interest rates at 0%, 0% for 12 years. And this has inflated all these bubbles higher and higher and higher. Okay, now here's the other thing. The Federal Reserve, now they've been buying these mortgages. They've been buying mortgage-backed securities is what they're called. And they've been buying these in the tune of, let's call it, $30 billion a month, right? And this has supported the housing market by keeping the mortgage rates low, right? Well, okay, so now we've kind of had this change in direction. We've had a change in direction where the Federal Reserve, they've raised rates from 0% up to about 2.5%. Okay, and what did mortgages do? Well, they went from 3% up to about 6%. Okay. Now, if the Federal Reserve does what they say they're going to do, and they're going to not buy any more mortgage-backed securities, and they're going to sell them, what's that going to do to mortgage rates? My opinion is this will push mortgage rates from the 6% level up to the 10 or 12% level. Okay, but are they actually going to do that? Well, they say they're going to do that. They say they've stopped purchasing mortgages. But if you go on their website, this is not true. They have continued to purchase mortgage-backed securities. They were supposed to start selling their own mortgage-backed securities onto the marketplace starting in last June. They haven't done that yet. They've continued to buy. Why? Because they don't want the housing market to come down. If they lose the housing market, then they're going to lose the stock market. That's just the way it is. So they've continued to buy these mortgage-backed securities. And let's think about what if they stop doing that. Well, interest rates are going to go a lot higher. 10% on mortgages, 12% if you don't have an 800 credit score. Okay, so they have to continue to buy these, but they really are telling us, lying to our face, saying that they're actually selling mortgage-backed securities. I don't believe it. Now, here's why I don't believe it. Well, think about this. When they bought all these mortgage-backed securities, when they bought all of these bonds, they have $9 trillion, with a T, $9 trillion of them that they hold. They bought them when interest rates were at 0%. Well, they've raised these interest rates to 2.5%. So this $9 trillion on their books right now have unrealized loss. An unrealized loss means they haven't sold them yet, so that's not a realized loss, but they have come down in price. Now, why have they come down in price? Well, interest rates were at 0. If interest rates go up, bonds and these mortgages that they hold tend to go down in value. So they already have an unrealized loss of about $1.6 trillion. Now, they only have to make that a realized loss when they sell these assets. And now, who's responsible for that $1.6 trillion? Well, it would be you and me. It'd be the taxpayer. Do you realize the Federal Reserve never takes a loss? Any loss that they have is passed on to the taxpayers, me and you. Now, isn't that great to have a private company? Federal Reserve is not owned by the government. They are a private company that the taxpayer, have to pay for all their losses. So they bought $9 trillion worth of these assets, and if they sold them right now, they would take a $1.6 trillion loss. That's why they don't want to sell them right now. They also don't want to sell them right now because it would crash the market. The market would crash, and that's just a fact, okay? So they're continuing to buy mortgage-backed securities to keep interest rates low. Now, at some point, I do think they will stop buying these mortgage-backed securities, and I think that will push the interest rates of mortgages up to the 10% level. Now, what's that going to do to the housing market? Well, it's not going to be pretty. It's going to send them down lower. Now, we got another form of what's called the subprime mess. Okay, so the subprime market crashed in 2008. These were giving loans to people that they shouldn't get loans. Now, in the past, you were always able to refinance your house, to pull money out of your house because interest rates went down and your home equity went up, and you could take money out of your house. You could continue to live beyond your means. Now, the federal government, we've been living beyond our means for, well, forever almost, right? Because we have the reserve currency and we can live beyond our means. Now, and people have been living beyond their means now, right? They've been doing it by pulling money out of their properties and living off of that money. But the properties go up, Mike, so that's not really living beyond their means. True, that's true. All right, so they've taken this PPP money, they've taken this unemployment money, and they've lived beyond their means. And their houses are now starting to go down. And interest rates have gone up. So now they're looking for a place where can I get money to live on? Where can I get money? I can't go refinance my house now because the interest rate, it went from 3% to 6%, which is an incredible jump. It's an incredible spike up. How are they going to get money to live? Banks have, well, the houses have always been like an ATM machine at your bank. And the banks have given the loans to the people so they could continue to live beyond their means. Live beyond their means by, spending more than they're making, more than when they're making. Their house has always allowed them to do this. And now the house is still allowing them to do this. It's called a HELOC. It's called a home equity line of credit. And this is what the banks are pushing right now. Now, these HELOCs have what's called, well, they have a teaser rate. Let's say they give you it, for 5% for the first year, and then it goes to the market rate 6, 7, 8% after that, after you get that HELOC. And they require you to take like $75,000 to $100,000 out. Now, once you get these loans, these are not no recourse loans. For example, if you use the money to purchase your house, that is a no recourse loan. If you decide to give the house back to the bank, they cannot come after you for the money. The house is full payment for the money. But with the HELOC loan, and you get in trouble, which some of these people are already getting in trouble. They can't make their mortgage payment and the HELOC payment at the same time, so they're in trouble. They give it back to the bank. Well, the bank can still sue you for the amount of the HELOC loan, because that is not a non-recourse loan. That is a loan with recourse, meaning that the house does not satisfy that judgment. They can come after you later and sue you and place a judgment on you, so any job you take, they can garnish your wages. A lot of people don't understand this. So the people that are living beyond their means and taking out these HELOC loans are going to get in a lot of trouble. And they're doing this right before a recession's hitting. Now, I'll tell you, we're already in a recession, but they're taking out these loans and a recession's coming. They may lose their job, all right? So they lose their job, they can't pay back these loans. Well, they're still on the hook for these loans, even if they give the house back to the bank. That loan, they're still responsible for it. The bank can sue them and get a judgment and follow them around for pretty much the rest of their life until they pay these loans back. That's the difference, and you got to understand, I would not ever take out one of these loans if you don't have to. Home equity line of credit are not, they're dangerous loans. They're dangerous loans. Look, if you need one, you're in trouble already. You're already desperate, right? You don't have money. You're living beyond your means, and it's going to come back and hurt you. It just is. Now, I know I rambled a little bit here today. It's Monday. I'm entitled to a little bit of rambling, but this is what's going on in the real estate market. They're going to continue to try to prop this up as long as they can. They're going to continue to buy mortgage-backed securities. They say they're not, but they're continuing to do it. Now, the interest rates, they are starting to go up, but I do think we're going to continue to print money to keep these asset bubbles inflated. It's just what they do. Once they lose this housing market, they're going to lose the stock market, and it's all going to become this house of cards that comes crashing down, and it's not going to be pretty. Now, if a lot of people say I'm a gloom and doom channel, I don't think I am. I'm giving you a warning. I'm giving you reality. But if you think it's gloom and doom and that it's too negative to watch, I understand. Don't watch. Don't watch. It's that simple. Anyways, I'm Tall Mike. I'm done rambling. Get out there. Have a great day. Give me that thumbs up if you can. Punch that subscribe button. Everybody have a great Monday. We'll talk again real soon. Bye-bye now.